Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. All right, my guest is Steve Moskowitz, Moskowitz LLP, on the show with me today. All right, Steve, welcome to the show. Thanks for being here.
Thanks for inviting me.
Give our audience a brief background on yourself and your company, and then we'll dive right into the things we're going to talk about today.
I'm tax attorney Steve Moskowitz. I founded what became Moskowitz LLP over 30 years ago. We go ahead and do everything in tax and some other things too. Before I was a tax attorney, I was a CPA. I'm also a legal analyst on television and on radio. We do a tremendous amount of things. I started as a sole proprietor, and then we grew and grew and grew, and we're a medium-sized firm now. We do everything in tax: domestic tax, international tax, everything from tax return preparation to knock down, drag them out, criminal trials for tax, civil, tax planning. There's so much in tax. When I even mention the word tax, I get so excited.
Okay.
And enough about me and our firm here in San Francisco, but we do cases all over the world. I was even had the honor of being honored by the national government of South Korea when they had me go to Seoul and address them on international taxes. So we really do everything from the most complex returns down to the simple ones and everything in between with tax planning. Now that I've talked about tax planning, I want to talk about my new favorite Internal Revenue Code section, Section 199A.
Okay, let's do it.
This gives us the opportunity to pay tax on only 80% of our income instead of 100%. Who in his right mind wouldn't rather pay tax on 80% instead of 100%? But of course, when the government gives you something, there's all kinds of loopholes and entanglements and wait and this and that. So one of our jobs as tax attorneys is to go ahead and get around them. And this is the first time in American law where it makes a difference what you do for a living. So you can have the situation where you make the exact same amount of money as your next door neighbor, but you pay more or less taxes just because of what you do. So how could that be? The government, in their infinite wisdom, came up with specified businesses. For example, doctors, lawyers, accountants, and they said there's going to be special rules for you. And what happens here is there's a listing on the groups, but also they have a catch-all. So it's not just somebody that's listed, but it's also something like if people come into your business because of the reputation of the business. Now, you don't want to be in this group. So what we're going to see in tax court, you're going to have the absurd situation of people going to court and say that people are coming into their business in spite of how awful they are to them. And here's why. If you're a specified business, there's some limits, and that's it. If you hit the limits, no benefits for you. However, like everything else, there's a way around that, which I'll explain in a minute. So suppose, for example, you're a physician. If you're single and you make more than $157,500 or married, $315,000, you are at the end of your 20% deduction. That's the 80% instead of 100%. Mm-hmm. Single, they give you another $50,000, married another $100,000 for partial. But once you go over that, let's assume you're married and you're a physician, you make more than $415,000, zero benefit for you.
Right.
So what do we do? Well, for example, with the physicians, what we're doing is going ahead and setting up other businesses that are not specified. So let's think about something like an orthopedic surgeon. Normally, an orthopedic surgeon has a medical practice. But here, what we do is we're going to set up other businesses, S corporations, and I'll tell you why a little later. And what happens is he now has a separate business that is selling what I'll call the replacement parts, the artificial hips, the artificial knees. Why is that? Because the business of selling the products is not a specified business and is not subject to these very stringent rules. There's other restrictions, but they're easily gotten around. So step one is, are you a specified business or not? So if you're something like a physician, what you want to do is set up other businesses, obviously with economic reality and business purpose, that are not subject to the strictest rules. That's the way you get around it. You say, okay, terrific. Suppose I do that, or I'm a business that's not in that specified group. Then we have a situation where once we go over those magic numbers, we'll use the 315 in my example. What do we need to do? So you have a balancing act. Now, forgive me, we're going to have a little bit of numbers. So anybody watching this, I promise I'll make it worthwhile. So stick in for the number.
Okay.
And what happens is this. You have the lesser of the 20% deduction or some other restriction. So let's make it easy. Let's assume that you make a qualified business income. That's the official word. It's really a profit of $1 million. Okay, well, you're way over 315 and 415. So a 20% deduction, you'd only pay tax on 800,000 rather than $1 million. But it's the lesser of that or some other things. The first thing is the lesser of half the W-2 wages you pay. So let's concentrate on that one. And here's why somebody that's a sole proprietor would want to consider being an S corporation. Although theoretically, this does apply to sole proprietors and a lot of other type of business too, the restrictions are going to hurt you. A sole proprietor can't pay himself or herself W-2 wages. So let's assume that someone watching this says, okay, I'm going to become an S corp, easy to do. Now, we're back to our $1 million profit times 20%. So we're going to pay tax on the 800 if we can meet the restrictions. So all this business owner has to do is pay anyone, including himself, say he has no employees other than himself, pays himself double the deduction amount, and we meet the limits. So let's go back to the numbers. We have $1 million profit, 20% deduction, we have the lesser of 200,000, or 50% of the W-2 wages. So here in my example, this business owner pays herself $400,000. Now we do the calculation, a lesser of 20% of the profit, 200,000, or 50% of W-2 wages, 50% times 400,000 is 200,000. We have a $200,000 tax deduction, boom, out of the air, gift. And this is wonderful. Also, a side benefit from being the S Corp is you have what's called asset protection, because unfortunately in our society, when you have something today, there's some other individuals who think it's unfair that you have something and they want to come and take it away from you with a lawsuit. So what happens with a corporation, assuming you otherwise qualify, your personal assets are protected where you wouldn't be with a sole proprietorship. There's other ways to benefit here too. For example, we can get around the restrictions by having assets like depreciable property. A building is 2.5% of that, but I don't want to take up all my time with that. I'll just say there's other ways to get around this besides the wages, like having a building or other assets. But
we can drill down into those on subsequent interviews, because I can see that this would be great to move forward with, and you break them all out, but please keep going.
I'd love to. The government gave us a real gift with depreciation in this new tax law too. What they've done is they increased bonus depreciation from 50% to 100%. And this is for property that has a useful life of 20 years or less. So the bottom line is, instead of having to depreciate something over many years, you can write it all off on the first year, which is terrific. That would also include certain vehicles. For example, you get an SUV for business, it's over 6,000 pounds, you can write the whole thing off. And there's other ways too. For example, in another segment, I'd like to talk about cost segregation analysis. And what that does is, we know with a building, normally we depreciate it over 39 years. Mm-hmm. With this, we send an engineer to the building, and he or she looks around and says, okay, well, this is 39-year property. This is 15-year property. This is 10-year property. And this is 5-year property. And boom, it greatly accelerates depreciation. And you, of all people, know the value of the time value of money. That's what this does. And this is terrific. And you're watching the show here and you say, oh, no, I bought the building last year or the year before that or 5 years ago. I didn't know about that. I wish I had that. No problem. You just file for a change in accounting method. You see, I get excited over this stuff. You file for a change in accounting method, and then you can go ahead and do it. So that's one of many things we can do. And you say, okay, there's other things. For example, if you have big losses, somebody's going to say, hey, well, wait a minute. My accountant told me, well, before I was a tax attorney, I was a CPA, so I'm familiar with those things too, that a loss from a building, a rental building, is passive. And I can't offset that loss against my ordinary income. Well, there's some exceptions. One is if you have an adjusted gross income of less than 100, you can write off a max of 25,000. Over 150 AGI, no write-off for you. Let's talk about those people. So I told you about this wonderful accelerated depreciation. Now you have a big loss on your building, and all these subjects I can talk about in a lot more detail in the future. And you say, I want to go ahead and write this big loss off from my rental building against my profit in business, wages, dividends, interest. How can I do that? We look at our friend Internal Revenue Code section 469, and all that you have to do, only one spouse has to qualify. You become a real estate professional. And essentially the big deal with a real estate professional, you spend more than half of your business time on the real estate, which works out perfectly for people that have a house spouse, one spouse that works and one spouse that stays at home. And then what you do is then, as long as you otherwise qualify, the topics of another show with you, you can write off unlimited losses. So you can literally make millions of dollars and legally not pay a penny of tax. And as far as that goes, look at the Fortune 500. All those giant corporations making billions with a B in profit and not paying any taxes. So the tax law is chock full of these things, because what happens is when people think about the tax law, they think about extraction. You got to pay this, you got to pay this. But the tax law has two purposes. One is to collect money, but the other one is a system of incentives. For example, the government can't order you to go out and buy a rental building, so they give you incentives. And this is what this is all about. They give you incentives. And that's what tax planning is you say the government has given me incentives, and I'm going to go ahead and utilize them and not pay the taxes. That's my reward for engaging in economic behavior that the government would like me to do. And there's so many things. For example, I don't know how much time we have left.
Well, we're at the end of our conversation, but I want to bring this out because we didn't cover cryptocurrency. We need to drill down more into real estate, and then cannabis laws. These are topics that let's do this. Let's call it. Let's end it right here on this one, and then have you come back, and we'll take each one of these individually as we go forward. How does that sound?
That sounds wonderful, and I'd like to add some other topics too, like pensions, because, for example, with pensions, the fancy pensions, there's all different types. You can put away even millions of dollars in 1 year if you otherwise qualify. And the beauty is, number one, with most deductions, you have to pay it by December 31st of year one to deduct it in year one. With pensions, although a lot of the pensions need to be set up by the end of year one, you have until the filing of the return plus extension in year two to pay. So what that means in English is that you get a deduction for year one, but you don't have to pony up the cash until 3/4 of the way into year two. And if you're in the top tax bracket, federal and state, which approximates half for a lot of your viewers, if you, for example, would put away $200,000 in a pension, you'd save $100,000 in federal and state taxes. I thought of another way. If you decide not to put away the $200 for yourself, you'll give $100,000 of that to the IRS and the state for having nothing, which is a no-brainer. And we have something even more. What we have is most of the pensions are protected by ERISA, which means, think back to protecting ourselves. Some guy wants to sue you. Most of the pensions are essentially judgment-proof. And for that one, although I hate to mention his name, but this is another context, look at O.J. Simpson. He hasn't lost a penny from his pension. That's very important for business people. I got a host of things. Whatever you want to invite me, I am delighted to come on your show.
Please, you're going to be back because everybody needs to know more about this. I just want to cover one topic at a time so that actually that people can take a bite out of the elephant one bite at a time instead of trying to eat the whole thing in
That'll be terrific.
meal.
In the future, I'll give you one topic at a time. We'll drill down more into the details. Even the things we talked about today, there's a lot more details. Will be very, very, very valuable to your viewers.
Great. Steve, thanks for being a guest on our show. I really appreciate that.
Thanks so much.
You're welcome. All right, you've been watching CEO Money with Michael Yorba. Don't forget, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel. We'll be back with more content just for you.